welcome to Wealthy and Wise. This week, we are going to dip our toe into the psychology of investing. So, how do you decide when to buy or sell? And why do the stocks or assets you own often have more appeal than those you don't? We'll get to some research on investor behavior, which shows we value losses worse than wins. And we often take decisions that are mutually incompatible. And we will also answer some of your stock-specific questions. So first, let's get going and add some value. Investment markets are driven by more than just fundamentals. Investor psychology plays a huge role and helps explain why asset prices go through periodic booms and busts and why share prices can react in extreme ways to events. The key for investors is to be aware of the role of investor psychology and its influence on them. So joining me to discuss, Teaminvest's Andrew Coleman and AMP Chief Economist, the Dr. Shane Oliver, is joining us. All right, we'll start with you, Andrew. So if it really is that easy, buy low, sell high, why do so many people find it hard?
Yeah, I think it's one of three reasons. There's a cynical answer, which is that I think no broker or advisor has ever got rich by telling clients they can get rich slowly by doing simple things. The incentives are to create activity and to create a need for their advice. And that often pushes people away from easy to follow good advice, even when the results are positive. Perhaps being a little less cynical, the more obvious answer is we don't have perfect information. We're making buy, sell, hold decisions around imperfect information about the future. And because there is uncertainty in that, we sometimes get those decisions wrong. But I think the real answer, the one that does far more than either the cynical or the obvious answer, is just simply even when the advice is good, information is reasonable, and there are no mixed incentives out there, we as a species are predictably irrational. The study of that, of course, is called behavioural finance.
Okay, well, there's a lot in that. Shane, how does investor psychology contribute to these boom and bust cycles?
Well, to be honest with you, Nadine, I think it's the major driver. Now, it doesn't act in a vacuum. Investor psychology does play a huge role, but it's often triggered by something positive. So if you go back to I'll stay away from the current situation with AI, and that may be becoming a bubble. But if we go back to the tech boom of the late 1990s, there was lots of reasons to be optimistic back then. But that optimism obviously propelled markets to excessive valuations, particularly for tech stocks. And then, of course, the market got ahead of itself as a result of investors piling in, pushing share markets higher, and then had to go through a severe correction in the early part of the 2000s. And of course, once you go from extreme optimism, you can then plunge all the way down to extreme pessimism as investors are in a rush to get out. But there's a combination of investor psychology traits that drive that. But one of the big one is this tendency for investors to project recent strong gains or recent gains off into the future. So if the current environment has been very positive, lots of good news, people will assume that will continue. Then they pile into the share market, pushing it to extremes. It starts to feed on itself to some degree, and then that eventually sets up a bust.
Well, so if it's so predictable, why still do people find it so difficult to buy when everybody's panicking and to sell when everybody's euphoric, Shane?
Well, I think it's because that requires operating in a manner which is contrary to the crowd around you. And this is the part of crowd psychology, which is critical here. Now, of course, there are investors out there. Warren Buffett would be one, for example, who is perfectly happy to be contrarian. He's got a long-term time horizon, and his mental makeup was such that he can resist the crowd, so to speak. But for most of us, we have very imperfect information. We rely on what those around us are talking about at dinner parties. Maybe all the talk is about SpaceX or something. And of course, if everyone else is getting in, you want to get in too. And so when the market is up the top there, everyone's saying, I've made these fantastic gains. I'm doing really well. So the inclination is more inclined for people to get in rather than get out. So you end up buying at the top rather than selling at the top, which is what you should be doing. And likewise at the bottom, it works in reverse. Markets have come down so aggressively, people have lost money, everyone's talking negatively, you want to stay out. And of course, as we just heard from Andrew there, we do have imperfect information. You could aim to be selling at the top. You could aim to be a contrarian, but you may not get the timing right. You might say, for example, well, things are overvalued now. We've seen enough froth and bubble. I want to get out. I've made good gains over the last few years. I want to get out. But then you might find that 12 months later, the market is even higher again. The news flow remains good, and you regret that, and you end up getting back in again. So it's kind of hard at times to time the top and the bottom. I reckon it's probably easier at the bottoms than the tops, but it is still very hard to get that timing right.
Andrew, what sort of theories, if we can call it that, of investor psychology really resonate with you?
Yeah, well, I think there's sort of 8 key, I would argue, seminal papers, all of which won Nobels for behavioural finance. And they started, of course, with Simon's 1978 Nobel win in this idea of bounded rationality or satisficing, which is this idea that in theory, we are all rational economic actors and we will pore over all the information available and take into account everything we possibly can and arrive at an optimal decision, or at least try and arrive at an optimal decision. But when you actually analyze human behavior, there is almost no one who is doing true optimization. What instead we're doing is a concept called satisficing, which is we're really looking for the first decision that comes up that looks satisfactory. So, you can argue when it comes to your kids cleaning the room, right? In theory, the room should be perfectly clean. They stop as soon as it looks less messy and mum won't shout anymore, right? That's a concept of satisficing, but we do that around economic decision making. So in theory, we should be scouring the stock market for the very best places to put our capital, or asset markets in general, for the very best places to put our capital. But most of us being human don't. We look around until we find the very first thing that looks good enough, and then that's what we buy. And same thing around selling. So that's one really famous paper. The second one was in 1988, the Nobel winner of Allais for Allais Paradox, where he pointed out that we make decisions as humans that are often mutually incompatible. So theoretically, we should make the same decision in the same situation all the time. For example, if I'm risk averse and I don't like gambling, I will not gamble no matter the odds being offered. But of course we don't. The classic one is the lovely lotto example. We covered gin on one of the other shows. Great example with Jumbo Interactive. When lotto tickets are the same price, the number of people buying lotto tickets is determined not by the outcome of likely win, but by simply the prize money on offer. Those that offer bigger prize money with worse odds have more participants than those with a greater expected value, but a smaller winnings. I mean, that's completely irrational. If you won't buy the high likelihood of winning, you shouldn't buy the low likelihood ticket. And yet we don't. We sit out Oz Lotto when it's at 5 million, but if it's at 80 million, we all rush off and buy a ticket. So there are examples, that's 2 of them, but there are examples of these sort of constantly well found in economic research, foibles of human behavior that are predictably irrational. So they're irrational in the sense of if we were being considered and researched, we wouldn't do it, but we're predictably going to do the wrong thing. And the classic one you mentioned, of course, the very famous one, is prospect theory by Kahneman and Tversky, which won the 2002 Nobel Prize, which talked about that idea of an S-shaped preference curve, the idea that we treat wins and losses asymmetrically. Theoretically, we should have the same amount of joy or fear about winning or losing $10, no matter where we started from. And yet, as Kahneman and Tversky showed, what matters is not did we win $10, it's how much did we think we had before we made that gamble. And the more wins we have, the less we value future wins. The more losses we have, the less we value future losses, and we treat losses as worse than wins. And I think that one in particular describes so much of what Shane was talking about there around bubble behavior, because as the market goes up, we become less and less risk averse about the fact that it could crash, which is exactly the wrong thing to do. It's now more overvalued. And yet we treat the fear of it dropping as less and less important.
So, Shane, how do we as investors, I guess, look in the mirror and understand some of this psychology? Like it's another layer, it's another task. It's a hard job to do.
Look, it certainly is, but I think it's critical if you want to master the art of investing. The first thing to do is to be aware of this. Those academic papers that and research that Andrew was referring to is worth looking into. There's lots of good books out there on behavioural finance. So the key, I think, initially is to just be aware of it, that it's not all about fundamental economics. You can't just assume the market is just moving perfectly rational in line with the latest economic or profit data. It doesn't work that way. So you've got to allow for the impact of investor psychology. It's worth looking into it, looking at the key aspects of it and the way that impacts markets. Then I think once you've done that, you've got an understanding of it. And I think this is where Warren Buffett got to many, many years ago, perhaps even before many of those papers were written. You've then got to adopt something of a contrarian approach to investing. So you recognize that, as I said up front, that investor psychology does not effectively operate in a bubble. There's always some grain of truth behind what's caused investors to get very excited, such as more recently AI, or back in the 90s, the tech boom at the time. So you recognize that, and therefore that you can't dismiss these things straight away. You also recognize that you're not going to always get the timing right. You also need to look at, I think, measures of investor psychology. Where are we in terms of investor sentiment in relation to the market? Is it at excessively optimistic levels based on various surveys? And there's lots of surveys that come out on this. What's the ratio of puts versus call options looking at? Because if you've got a low level of puts but lots of calls, then maybe that could be a sign of excessive optimism and so on. And so these things are worth looking at. But effectively, you have to become a contrarian in terms of the way you look at these indicators. When they're at extremes, when the crowd is all piled in, that is a time to think, well, maybe I should be a bit cautious. When it's the other way around and everybody's out and everyone's talking about the end of the world and the sky has fallen and we got a recession and profits are collapsing, maybe that's a time to start buying in again. In between times, on that chart there, at the extremes, that's where the opportunity is. When you're at the high point in the market, you've got euphoria. That's when it's most risky. When the opportunities are perhaps best on the downside to sell, and vice versa when the market's at the bottom. In between times, I think fundamentals do play a much bigger role, and it's hard to operate just looking at investor psychology. But the key, I think, is to get an understanding of it and work out how that does impact markets. And once you've done that, then I think you're well placed to go forward as an investor.
Andrew, can you get better returns? Like, will this, if you try to understand your own psychology, if you try to be contrarian, as Shane was detailing, can you improve your returns?
Oh, absolutely. I think to that point, it's even more important beyond just understanding the market psychology. I think that's important, but to understand your own psychology, because at the end of the day, assuming you are managing your own money, and we are all in some way managing our own money, even someone who chooses to abrogate the individual stock picks by handing it over to a fund manager is still selecting the fund manager or the superannuation fund. Understanding your own biases and your own likely decisions that are irrational is critical to making sure that you avoid them and you make the right decisions. And there's a couple that are particularly important, I think, for the average person beyond just the academic theory for the market as a whole. And those two in particular are, well, if I can say three actually, are the narrative fallacy, confirmation bias, and the concept of endowment bias. Now, the narrative fallacy is the idea that we as humans really want to assign a story and a reason to things that happen, even if they're random. So we want to assign stories to random events, which then can have the risk of becoming self-fulfilling. So a great example is a company may have no news on it. Its share price rises 2 or 3 days in a row. Now, that's just standard probability. Flip a coin 3 times, you can get 3 heads in a row. And yet very quickly within the market, there will be article after article writing about why the share price has risen and why that is an indicator that this company is actually really good, which feeds further share price rises because more buyers come in the market, and the story takes on a life of its own, or vice versa. When it's dropping for no reason, the story takes on a life of its own around the fall. Now, that's a very easy trap to fall into as a human. We get caught up in that sort of behavior of crowds, but it's one you can really easily solve, because all you ever need to do to avoid falling into the narrative fallacy is to stop your thinking for about 5 or 6 seconds before you make your investing decision and go and look at the underlying data and ask, is it true? All of these news articles are saying something. Is there any evidence from the company itself that that's occurred? Simple sense check will often save you. The other two, confirmation bias, that's that idea that if we hear a piece of information that confirms what we already believe, we treat it as true. And if it disagrees with us, we think it's wrong. We don't change our position. We believe the information is wrong. You see this in politics all the time. You know, the whole team's idea of Donald Trump can say something and people who are on Donald Trump's side hear it as confirmation that Donald Trump was always right. And those of us with perhaps a slightly more cynical view of Trump hear it as negative about Trump. Doesn't matter what was said, we immediately fall into those categories. And again, you can stop yourself falling into that trap by just being aware of it, saying, look, I like this company. I'm likely to be positive. Can I black hat it and find a reason I shouldn't? And then thirdly, endowment bias. You know, there's a series of very famous studies, particularly the mug and pen study, which is a fascinating study. And really what it shows that we as humans immediately value something more just because we own it. So once you've made a decision to own something, whether it's a stock, a house, a car, a managed fund, be conscious of the fact that you will prescribe more value to that asset than you ever did before you owned it. And so be very careful, therefore, about making further investing decisions off the basis of your existing ownership.
Yeah. All right. I find this really fascinating. Shane, before we have to let you go, where are we in that sort of euphoria boom bust cycle right now, in your opinion?
Like, I think we're in the middle of the range. I don't think we're quite at euphoria yet. There are signs of it. You know, the enthusiasm regarding the SpaceX IPO, and then, of course, it fell 16% overnight. I'm often worried about IPOs, but anyway, yeah, the fact that we've got these IPOs, the fact that, I think it's something like if you take the three companies in the US, SpaceX, Anthropic, and OpenAI, they're going to be raising $200 billion this year from IPOs, whereas the whole of the IPO market in the US last year was about $75 billion. So a lot of money is getting sucked into the market. That's often a sign of an over-exuberant market. We're seeing debt levels rise dramatically for the top tech companies, and part of the reason SpaceX fell last night was because they're raising more debt via a bond issuance. So these signs are there, the telltale signs are getting there, but they're not at extreme yet. I don't think valuations are excessive just yet. In fact, recently we've seen very, very strong profit growth, which has pulled down the PEs on, say, US shares, and even to some degree Australian share PEs is down from its high. And also when you look at measures of investor sentiment, there's various surveys you can do this from institutional investors, from retail investors in the US. On our measure, it's around the middle of the road. So it's not at excessive levels yet. So I don't think we're at the sort of euphoria that we had in, say, 1999 or 2000. So that's why you got to be a little bit careful about this. And that would suggest to me that probably markets can continue probably to go up further from here before you get a major fall. You know, try the time, that's always going to be difficult. I always recall back in the late 1990s, you know, there was a feeling from the mid-90s of irrational exuberance. In fact, Alan Greenspan, the then Fed chair, referred to irrational exuberance. A book was written by Robert Shiller on the title Irrational Exuberance. I think it came out a year or two later. But this was around the mid-1990s. Yeah, talk of irrational exuberance on the back of the tech boom. And of course, that went on for another 4 or 5 years. So that's why you've got to be a bit cautious about the timing of these things, particularly on the upside. So my reckoning is that it's not clear just yet that we've got euphoria. I think we could still have a way to go yet.
Dr. Shane Oliver, AMP, thank you so much for joining us.
My pleasure. Thank you.
Take care. And backed by popular demand, stick around. We'll go head to head with some stock specifics next. So that's scratching the surface about the psychology of investing. Now let's take a look at some of the stocks you've been asking about. Andrew Coleman from Teaminvest, and you've got your trusty conscious investor as backup. All right. So let's get to these stocks. The first one on the list is Ingham's.
Yeah.
Protein.
Yeah, so I think been in the news a bit recently as well, due to some bird flu potentially over in WA. Look, I think Ingham's is an interesting company on the basis that you would think it is really stable and, you know, really profitable because it's providing effectively the vast majority of our protein in this country. You know, we eat more chicken than anything else, and Ingham's is the largest chicken provider. Yet, despite that, the earnings stability, as you can see from that chart, is a little bit all over the shop. So the dark blue line again here, for those looking at the chart, is the earnings. The light blue line is sales. While sales are relatively stable, throughout that period. Earnings are all over the shop. Now, I don't know Ingham's well enough to comment as to exactly why earnings have been all over the shop, but from a value investor, from a Teaminvest point of view, it therefore means Ingham's immediately fails one of our first hurdles, which is being virtually certain that I can predict what the earnings are likely to be in 5, 10, 15, or 20 years' time. As a result, we probably stop there. But for the purpose of looking at Ingham's today more broadly, I'll call out one other thing as well, which is the debt to equity. Have a look at how much debt Ingham's has. That's over 500% there, if I just hover on the chart. 561% debt to equity and over 100% debt to market cap. So I'm assuming, again, that's due to the large capital intensity of running these kind of operations. But again, that's a risk that we as long-term value investors at Teaminvest would just say is too much. So from that point of view, yes, the PE might look attractive at 13.3, but it's a no.
We had Metcash in the news this week as well. Profits fell, retail margins coming under pressure. But is this a stable business? I mean, we all need to eat.
Yeah, I mean, Metcash does have very good stability, more stability than Ingham's. It's around sort of the 80%. So again, if we have a look at the chart there, you can see sales and earnings have been increasing. Not as stable as many of them we call out here around sort of real wealth winners, but, pretty stable. There's a couple of years there that don't follow the trend. But in general, it's a slight upward trend, as you'd expect, slightly faster than inflation, which is what we see from all three major grocery players. They're able to grow their earnings at or about inflation with a very high degree of stability. Metcash, I've spoken about on the call with you before, is probably the best of the three grocery companies, in my opinion. But, there's enough yellows and reds on that chart pointing out where there are potential problems. So if we just call a couple of them out, return on equity is very good, 17%. Return on capital is not, just below 10%. And that's driven the difference there because of the debt on their books, which in this case is mostly leases in relation to obviously their store footprint. Currently available at a PE of 12.5, which is definitely exciting or interesting. And as a result, you're getting a pretty good yield and a pretty good net profit margin for a company of this type. I'd say if you like the grocery space, Metcash is probably the best of the three. I don't particularly like the grocery space. I think there's better companies out there you could own. So I'm going to say hold for the purpose of what I think you want from me today. But, if you're going to pick one of Coles, Woolies or Metcash, I'd go Metcash.
Okay, all right. Well, that's not a ringing endorsement. Okay, so let's go to BHP is the next on the list. So cost blowout at its potash project in Canada, leading to, a massive impairment. I don't think you're going to like BHP because it's beholden to commodity prices, right?
Yeah, absolutely. I mean, look, BHP has a cost blowout and a write-off every couple of years. I mean, that's the nature of mining when you're talking about huge capital intensity across the scale of geographies and regions that BHP operates in. There's always going to be one. And the joy of accounting standards, of course, is you never get to write the mines up that are performing well. You only get to write down the ones that don't. So if you've got lots of mines, you're always going to have impairments. So I think we tend to focus a little bit on that salacious news more than we need to. But if you look at BHP as a company, despite the clear issue that it's a commodity company and therefore it does follow the commodity cycle, and you can see that in that earnings and sales chart, it does have an incredibly good degree of stability in sales and earnings because they are probably the world's best miner.
Yeah.
And so, again, not interested in the space, as we've talked about before. It's very difficult to be virtually certain that earnings will be materially higher when you can't predict the price of the commodity. But from the miners, have a look at how much green and yellows there. I mean, that is probably the best of any miner we can find when you look at the ASX. I think a PE of 18.5 is a bit rich. I probably wouldn't be buying BHP now or ever for the comments you've made before. But if you do feel that you need to own a miner, BHP is probably the best you can own. Just make sure you pay a reasonable price, which history tells you tends to be in the sort of PE range of about 10 to 12 for BHP, not 10.
Yeah, that's not where we are right now. Hit a record high last week. Now let's get to Xero. So Xero is a funny one. I was on LinkedIn the other day and I had people sort of writing in saying that, look, whilst it dominates the market here in Australia, it's actually not that advanced as far as a software, service goes. And then you've got AI threatening it as well. So what do you make of Xero?
I got myself in trouble about a year and a half ago on a video with you where I said it was more likely to go towards its name than doubling. And I think if we step back for a second and ask why, if we just pull up the information, you'll see this in a second. That's Xero sales and earnings. Now, That's wonderful sales growth. Have a look at how steady and nicely increasing it is. But look at the earnings.
Yeah.
This is not a company that has a demonstrated track record of being able to turn any of their sales growth into what matters, the lifeblood of the organization being profits and cash flow. And as a result, they are always going to be at risk, to the point of the article you were reading, of someone coming in and eating their lunch. Because if you're hugely profitable and you've got huge amounts of cash flow, if someone else comes up with a better mousetrap, well, you can either buy them or innovate to catch up. But if you're always getting by on the smell of an oily rag, by the skin of your teeth, raising your capital, then you are very, very exposed to any changes in either the market you operate or the competitive landscape. That's why we talk so much about moats and risks. And if you look at Xero, Xero really has never demonstrated that track record of high degree of return on equity or return on capital. I mean, that's its return on equity and return on capital. It's negative most years. In other words, it burns more money than it generates. And as a result, they have to keep innovating with a thinner and thinner budget in order to survive, which is why I have no idea why the market has assigned a market cap of close to 12 billion or a PE of, just the small end of 6,240. That to me sounds like a lot of people are going to lose their shirt.
Okay. We've got one more up our sleeve, and that is A2 milk. So regulatory approval in China to convert 2 infant formula registrations into its own brands. But is it a marketing exercise, or what do you make of A2 milk?
Yeah, A2 milk's an interesting one, because if we remember, it was a market darling about 6-7 years ago, and then it was exposed for the risks that it had, which is that the vast majority of its revenue was coming from that, I'm going to pronounce it poorly, but daigao trade, with people coming in from overseas to buy milk on our shelves and send it back home. And once that trade was sort of put down, so too did the margins of the company contract. And you can see, as we've said before, you can see how often we've covered the company up here, 18 times in the case of A2 Milk. And what we were really talking about in those days was the growth in margin and earnings sustainable because of the nature of their business model. And our membership across the country, our 750 members, tended to fall into the group that it wasn't. So we didn't pass it. We weren't interested in it. But this second wave of A2 Milk growth is now, of course, not being driven by that same business model. So we haven't looked at it for a little while. Maybe it's time to look at it again. The reason we haven't looked at it is that big cross next to earnings stability. Everything else looks quite good from an A2 Milk point of view. But just to talk about what we were saying before, here's that sales and earnings path, and you can see exactly the point we were talking about, that lead up to the end of COVID, that daigao trade, followed by huge collapse in margins for the business, and now a slow and steady increase from there. Probably another year or two of that increase, and it will come back on our radar. We want to see a long period of data. I therefore would say PE of 24 looks probably about right, and I would wait it out till I had more information.
Okay. So that is a little value call for you out there. Let's get to our viewer question. If you have a question, you can email us wealthy@ausbiz.com.au. And while we're at it, Sarah has asked about WiseTech. What is your view of WiseTech? Can it ever overcome its issues? So we've had another sort of negative headline about its founder, Richard White, this week. So without commenting on that in particular, key man risk, that's for real.
Yeah, look, in the end, all businesses are run by people, whether it's the board, the senior executives, the people making decisions in the organization. And when the culture of the organization or the people at the top starts to mean decisions are made that may not be in the best interests of you as their partner, whether that's as a customer partner, a supplier partner, a staffing partner, or a shareholder partner, it tends to be that the one with more information wins. That concept of information asymmetry and moral hazard. Who's going to know what they can do to pull the lever best? Well, the person inside the company, which is why most thefts occur from inside companies. Not that this is a theft, but in general, it's that classic story. The insider threat is usually worse than the outsider threat in intelligence. I think the challenge with WiseTech is twofold, though. Firstly, WiseTech's numbers look outstanding, and they have for a very long time. They have been able to grow at between 20 and 30% per annum now for over a decade with a high degree of stability, and done that with a not particularly exceptional, but a reasonable return on equity. The challenge has been in the last few years, two things have changed, or three things really have changed at WiseTech. The first is that in order to keep making more and more acquisitions, and particularly this new E2 Open acquisition, they've taken on an inordinate amount of debt. They've gone from 6% debt to equity to over 130% debt to equity in under 6 months. Now, that's a risky move. And perhaps one might say it's another symptom of the hubris that is taking over the management team at WiseTech, that they think they can dominate the world in everything. The second element is that clearly there's a cultural problem. They've lost a whole board once. I think it was Oscar Wilde who said about being an orphan, to lose one parent is a mistake. To lose one parent is a tragedy, to lose two smacks of carelessness. I sort of feel like when there's board turnover of that size, it stops being a tragedy and it's carelessness. Something is wrong. There are enough articles for people to speculate around what the cause of that wrong is, but something is wrong, right? And now they're talking about sacking a huge amount of staff, and those staff are not happy about that. Surprise, surprise. Who has ever been happy about being told you're going to be sacked? So there's clearly a cultural problem. And so that then brings you to the third question you always have to ask when you see a company with a potential hubris, material changes in strategy, and issues around culture, which is, why do you want to own something that's going to keep you up at night, constantly worrying what the next piece of bad news is going to be? And in bad news case here, I don't just mean the peccadillos of an individual. I mean, are the numbers real? There's a lot of history that shows when culture is rotten, it turns out that you find shortcuts have been taken, audit standards have been breached, numbers have been reported to the market that are maybe not as factually correct as one would like. At what point is that going to come out about WiseTech, or will it come out about WiseTech? And so I would say, when you look at that, we've all got limited capital, some more limited than others. I'd love to have unlimited capital. Yeah. And as we don't have unlimited capital, why own a company that has so many leading indicators of a massive scandal about to happen?
So, price for everything, though, it's at a 2021 low.
I don't think there's any price that could get me to lie down in the bed with a dog that will give me fleas.
All right. There's your answer, Sarah. Hope it helps. So, Andrew, thanks for coming in today. As always, really appreciate your time and your insights. That's Andrew Coleman from Teaminvest. Remember, if you'd like to send us a question, email us at wealthy@ausbiz.com.au. Thanks for watching this week. We'll see you next.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.